It's 3:11 in the morning. The house is dark, the street outside is empty, and you're asleep the way most people are asleep at 3:11, with no idea what your money is doing without you. Here's the thing. Your money isn't asleep. It never is. Somewhere in a system you'll never actually see, the number sitting in your account just put in a full night's work. It earned interest. It moved through a loan. It helped pay for a stranger's car, a stranger's kitchen remodel, a stranger's Tuesday, and in the morning, when you check the balance, it'll read exactly what it read last night. Not a cent more. The work happened. You just weren't the one who got paid for it. So, over the next 20 minutes, you'll see exactly where your money goes at night, the 3 places it works while you sleep, and which one of them you were never really meant to notice. None of this is a scam. That's the strange part. It's all legal, all public, all sitting in plain data that almost nobody bothers to open. You just have to know where to look, and once you do, you can't unsee it. The vault that isn't a vault. Start with the picture in your head. You probably imagine your money sitting somewhere safe. A vault. A drawer with your name taped to the front. A neat pile of cash, waiting patiently for the day you walk in and ask for it back. Look, that picture is comforting, and it's almost entirely wrong. The money you deposit doesn't sit anywhere. The moment it lands, it stops being a thing you own and becomes a thing the bank owes you. A number, a promise. And a promise, it turns out, is very easy to lend against. For most of banking history, there was at least a rule that forced banks to keep a slice of every deposit on hand, untouched, in case people came asking. They called it a reserve. Then, roughly in early 2020, that rule in this country quietly dropped to 0. No mandatory floor at all. That doesn't mean a bank empties the building overnight. They keep what they need to stay standing. But the old wall between your money and the bank's appetite for it got a great deal thinner, and nobody mailed you a letter about it. Here's what nobody tells you at the teller window. One major central bank studied how this works and admitted something most people go their whole lives never hearing. Banks don't wait for your deposit and then lend out a piece of it. The lending itself creates the money. Your deposit was never really the fuel. It was the permission. And permission, it turns out, is the single most valuable thing you hand across the counter the day you open an account. 2, follow the $100. So follow a single $100 through one night. You deposit it on a Friday, payday, and you've forgotten about it before you reach the parking lot. By Friday night, that 100 is no longer $100 in a drawer. It's a line in a ledger, and the bank has already promised it forward. Some of it becomes part of a car loan for someone 3 towns over, a person you'll never meet, who's paying 6 or 7% for the privilege. Some of it backs a mortgage, a credit line for a small shop, the float that lets 1,000 other cards clear at midnight. While you sleep, that 100 is busy in a dozen places at once, the way a single drop of water can be in the river and the rain at the same time. By Monday, your statement still says $100. It earned its keep all weekend. You got, a fraction of a cent. Most people picture their bank as a place. It's closer to a current. Money flows in, money flows out, and the bank stands in the middle of that current with a very fine net, keeping the smallest, steadiest cut of everything that passes through. The net is the whole business. Not the marble lobby or the app or the friendly voice on hold, the net. And the genius of a net is that you never feel it close. The water doesn't notice. The water just keeps moving, which is exactly what the bank is counting on. 3, the first engine. The spread. Here's the first place your money goes. And it's the big one. It gets lent. Not the bills you handed over, remember. The promise those bills became. The bank puts your balance to work as a mortgage, a car loan, a business line, and it charges the borrower real interest, the kind with a number that moves the needle. Then it turns around and pays you for the use of your money. And the rate it pays you is where this whole quiet machine lives or dies. Run the numbers. Right now, the average bank earns a spread of roughly 3 1/3% between what it makes lending and what it pays out. That's the industry figure for late 2025. And it happens to be the widest that gap has been since before the pandemic. Meanwhile, the savings rate at the biggest banks sits somewhere between almost nothing and 0.5%. So picture the trade. They rent your money out at 5 or 6. They pay you pennies on the 100. They keep the gap every single day while you do nothing but trust them. That gap has a dull name nobody says out loud at dinner: net interest margin. Strip the jargon off it and it gets simple fast. It's rent. It's the rent your money pays to a landlord, except you happen to own the building and they collect the check. Sure, 3% sounds small. 3% of nearly every dollar deposited in the country, earned quietly, all year long, is one of the largest businesses that has ever existed. Here's the opinion I'll stake my name on. The interest on your savings account isn't a reward for saving. It's a thank you note for a loan you never knew you made. 4. The second engine. The swipe you don't see, now the second's place, and this one is sneakier because it happens during the most ordinary things you do. A coffee, the tap at the pump, the thing you order at 11 p.m. and pretend you didn't by morning. Each time that card moves, money moves with it, and a thin sliver peels off and goes to your bank. They call it interchange, a swipe fee. You never see it because you don't pay it at the register. The store does. But here's the part the store would love you to understand. They don't swallow that cost and smile. They fold it into the price of the coffee, the gas, the thing at 11 p.m. So you pay it anyway. One layer removed. Every time you reach for plastic instead of cash. How big does that get? Across all the banks in the country, spot swipe fees ran near $66 billion last year, give or take, up from 64 the year before. 66 billion. For the simple service of letting you tap instead of digging for bills. And the real trick is the invisibility. A fee you can see makes you angry and makes you shop around. A fee baked into a price just makes you grumble that groceries got expensive again. Your cousin complains about the cost of eggs every single week. He's half right. Some of that egg money was a toll, and the toll booth belongs to a bank. So here's the thing about your spending. The bank doesn't need you to be wealthy to earn off you. It just needs you to move. 5. The third engine. The fee that finds the empty account. Then there's the third place. And this one is harder to say out loud, because it doesn't fall on everybody. It falls hardest on the people with the least room to take the hit. When an account dips below zero, the bank covers the gap and charges a fee for the favor. Overdraft. Sometimes $35 for being $4 short. Across the country, banks and credit unions pulled in over $12 billion in overdraft and related fees last year, roughly. And about a quarter of people live in a household that pays them at some point. Look at where that lands. The fee hits the account that's already empty on the 28th. The person who can't quite cover a $7 sandwich gets charged $35 for the trouble. The person with 50,000 sitting idle never feels a fee in their life. Same bank, same building, different number beside the name. Be careful here, because this is the exact spot where it's easy to get angry and aim it at the wrong target. The teller didn't decide this. The branch manager didn't. The system doesn't hate you. It just never thought about you at all. And at a large enough scale, being ignored and being punished start to feel like the same thing. The bank wasn't being cruel to you the month you ran short. It was being indifferent. It priced the risk of you long before, on some quiet Tuesday morning, and it never once asked how your week was going. 6. The trap built out of your loyalty. So let's talk about the trap, because there's always a trap, and this one is built out of your own loyalty. You opened the account years ago. Maybe your first paycheck went in. Maybe a parent picked the bank for you when you were 16, and you've stayed the way most people stay, because switching feels like a hassle, and the difference looks too small to chase. Here's what they're quietly counting on. When rates rise, the bank starts earning more on every loan almost immediately. That part moves fast. The rate they pay you, though, moves slow, if it moves at all. There's an internal name for customers who never shop around. It isn't an insult. It's just a category, and the pricing follows the category. You won't feel it yet. You will. Because over 5 years, over 10, the gap between the rate you could have had and the rate you accepted compounds into a figure that would make you wince to see written down. Sure, 0.5% a year sounds like rounding. 0.5% on a balance you hold for a decade is a flight home every couple of years that you quietly handed away for the crime of never checking. The trap was never that the rates are evil. Plenty of places pay more, and they're one search away. The trap is that staying never once feels like a decision, and a drift you never chose is the most expensive choice you'll ever make. 7. The honest math. Let me put a real number on it, the honest way, with all the hedging it deserves. Say you keep $10,000 in a big bank savings account, paying close to nothing. In most years, a higher yield account somewhere else might pay you a few percent more. On $10,000, a few percent is a few $100s a year. Doesn't sound like much, and that's the whole point. That few hundred is the bank's now, every year, in exchange for you not clicking a button you've been meaning to click. Then run it forward. Run it across the boring decades where nothing dramatic happens to your money at all. The amount you left on the table doesn't just sit there politely missing. It would have compounded. The bank knows that better than anyone. They're compounding it right now, on their side of the ledger, in their direction instead of yours. And none of this requires them to do a single thing wrong. That's what makes it so hard to stay angry. They told you the rate. It was printed on the page. You signed. The fine print was never hidden from you. It was just boring. And boring is the best hiding place anyone ever invented. Most people never read the rate because the rate feels too small to matter. The entire night shift of the banking business is built on precisely how small it feels. 8. What it actually comes down to. So here's what it comes down to once you scrape away the marble and the friendly app. A bank is a machine for turning your patience into someone else's profit. Your money sitting still is the raw material. Your inattention is the grease. And the whole engine runs quietest, exactly when you trust it most. But there's a warmer part too, and it's just as true. So don't walk away thinking you should stuff cash in a mattress. The same machine is the reason you could buy a home you can't pay for in one lump. And the reason a shop across town made payroll this month. It's why your card works at all when you tap it. The system was never out to get you. It was never on your side either. And it never once pretended to be. Once you can see that plainly, something shifts. You stop feeling betrayed, which was never useful anyway, and you start feeling something that is awake, because the only thing standing between you and a fairer cut of your own money is a number you've never looked up and a small decision you keep postponing because it feels too tiny to bother making. Somewhere right now, it's late, past midnight, and someone has the banking app open for the 3rd time tonight. The number hasn't moved since the last look. It won't. They feel a little foolish for caring about a rate this small, and they're tired, so they close the app and tell themselves they'll deal with it someday. Most people stop right there. That's the honest truth of it. But a few don't. A few do one small, unglamorous thing in the morning. They look up what their savings rate really is, the actual number, not the one they assume. They spend 15 minutes comparing it to what's out there, the way they'd compare the price of anything else they were about to buy. Maybe they move the money. Maybe they don't. But for the first time, they made it a decision instead of a drift. That's the whole turn, not a windfall. A look. You're one of 2 people watching this right now. Not the rich one and the broke one. The one who closes the tab tonight. And the one who looks up the rate tomorrow. The number on the screen doesn't decide which one you are. The next 15 minutes do. None of this is financial advice, by the way. It's a nudge to go read your own fine print. Your money doesn't sleep. The least you can do is wake up to where it goes. If Walter's worth a few quiet minutes of your week, the subscribe button's right there, and it isn't going anywhere. Neither is your money. It's just working for someone else, every night until the morning you decide otherwise.